Hello, I'm Steve Friedman, Senior Macroeconomist at Mackay Shields. Welcome to our first episode of Forward Guidance of 2026, recorded on Tuesday, January 15th. I'm joined by Michael DePalma, co-head of Global Fixed Income, for our usual discussion on the outlook, markets, and investment opportunities. Welcome back, Michael.
Great to be back, Steve.
Michael, during our last episode in mid-November, we laid out our very constructive outlook for the U.S. economy. And if anything, I'd say that there now appears to be even better momentum going into 2026 than we thought at the time. Q4 growth is tracking at a healthy level and really not showing much damage from the shutdown. And while payrolls growth remains soft in December, I am encouraged by some survey data, for example, from both the ISM and the National Federation of Independent Businesses, that suggests that labor demand may be stabilizing. I'm also encouraged by some of the recent housing market data. And we can't forget the pickup in productivity, which explains the combination of weak payrolls growth last year, but decent growth. But let's jump right into markets. I want to start with primary markets. Early January has seen robust corporate issuance. That's not atypical, but I have been impressed by how easily markets have digested the supply.
You're right, Steve. The momentum is real. U.S. GDP growth in Q4 is tracking much higher than we expected back in November, likely around 2.5% to 3%, showing that the economy brushed off the shutdown disruptions remarkably well. And while hiring has definitely slowed, that productivity boost you mentioned, which we see running at a solid, let's call it 1.9 to 2% trend, is the secret sauce, allowing the economy to maintain decent growth even as labor demand cools. The drop in the unemployment rate to 4.4% in December was a key signal for us that the labor market is stabilizing rather than collapsing, which likely keeps the Fed on hold for now. And turning to your point on the markets, the start of 2026 has been historic. The first full week of January was actually the fourth busiest on record for investment grade issuance, with nearly 96 billion coming to market. What's truly impressive isn't just the volume, but how easily it was digested. Investors came into the year with plenty of cash on the sidelines, and we saw deals over 4 times oversubscribed on average. And even with that massive supply, new issue concessions were tiny, averaging only about 2 basis points. And spreads actually tightened in some cases, which tells you that there's an enormous fundamental appetite for carry and high quality yield right now. Essentially, the market acted like a dry sponge. Even with a fire hose of new debt, it had more than enough capacity to soak it all up without breaking a sweat.
So we know a lot of the issuance that we've seen in recent months has been to fund the AI build out, including data center construction. So AI CapEx has been moving into a new, more levered phase. Does that raise any concern for you from a credit perspective?
It's a valid question. We're definitely seeing AI capex move from a phase of cash and equity funding into a more debt-heavy levered cycle, as evidenced by the surge in corporate issuance and data center securitizations. There's a compelling parallel, actually, to the late 90s dot-com era when telcos aggressively used debt to build out fiber capacity, only to see returns erode when demand failed to materialize fast enough. So, from a credit perspective, our, canary in the coal mine, if you will, would be a sequential decline in return on invested capital or a significant narrowing of the spread between return on investment capital and, the weighted average cost of capital cushion, which is currently sits at a pretty healthy 20% for the major hyperscalers. But it is something we're monitoring closely. However, we aren't going to sound the alarm just yet for a few key reasons. Number one, balance sheet strength. Unlike the 1990s telcos, today's hyperscalers generally carry AA rated balance sheets and free cash flow roughly 50 times greater. And then there's the sort of supply and demand issue where, current bottlenecks are on the supply side, access to GPUs and energy and capital rather than sort of a lack of customer demand. And then the securitization guardrails is also something to consider. While digital infrastructure supply is expected to grow to 60 billion in 2026, these markets tend to finance stabilized operational assets rather than speculative development, which provides some structural protection for investors. So essentially, we're watching that spread, the return on invested capital and the cost of capital relationship like a hawk. As long as these companies can monetize the build out effectively, the market should continue to digest the debt, especially since net treasury supply is expected to be 400 billion lower this year, leaving a significant void for high quality corporate paper to fill. You can think of it as a sort of a massive infrastructure race. As long as the highway, which is here the data centers, is being used as fast as it's built, then the tolls, the revenue that's generated, will keep the debt manageable.
Michael, I think those are some very important differences from the 1990s investment boom. That being said, I do wonder if increased debt issuance to fund the AI build-out will crowd out other types of investment spending. And to your point, we also do have to think about treasury issuance in the year ahead.
So it's really a fascinating dynamic. You're right. AI was the clear heavyweight champion of CapEx last year, and we expect that to continue with roughly 400 billion in AI-related issuance hitting the market this year. At least that's what's expected right now. And as for crowding out, we aren't seeing it in the traditional sense yet. In fact, what we're seeing is a version of I'm going to call it internal crowding out. Many of these tech giants are cutting back on share buybacks to prioritize AI CapEx. And more broadly, private domestic debt growth is actually sitting at the lower end of its historical range, around 6% of GDP, compared to the 17% we saw pre-global financial crisis. So there's more structural room for this debt than I think many people realize. And now, to your question on the fiscal side, the numbers are undeniably large. We expect the US federal deficit to widen to approximately 2 trillion this year, or about 6.1% of GDP. This will require significant funding, and we anticipate net coupon issuance to private investors will be around $1.46 trillion. However, the technical picture is more nuanced than the headline deficit suggests. The Fed is expected to be a massive buyer of T-bills, potentially soaking up 490 to 500 billion in secondary market purchases this year. And because of the heavy reliance on bills and the end of Fed QT, net treasury supply in 10-year equivalents is actually expected to be roughly 400 billion lower in 2026. So essentially, the treasury is stepping back just enough in the long end of the curve to create a void that this wave of AI-related corporate debt is perfectly positioned to fill. In a way, it's like a crowded restaurant where the most regular customers, which in this case I'd say is the Treasury, has decided to take a smaller table, finally leaving enough space for this new big group to come in, the AI hyperscalers, to sit down without having to wait in line.
That's a great analogy, Michael, and I think your points are very well taken. I do want to expand on them a bit by focusing on the joint actions of the Fed and Treasury. As you note, the Fed is expanding its balance sheet again via bill purchases, and maturing proceeds from agency securities will be reinvested into bills as well. Now, Treasury might respond to this new Fed demand for bills by shortening the maturity of its own issuance even further, that is, increasing bill supply. In that case, the consolidated actions of the Fed and Treasury are actually similar to the effects of QE, because there'd be less duration supplied to the market. And that brings us to the actions of the GSEs. The president has announced that the GSEs will begin expanding their mortgage portfolios again. It's a form of fiscal QE that might further reduce the net supply of duration to the market. I assume they are buying current coupon mortgages in the TBA market. Is that your understanding as well? And I'd also like to hear your views on what impact you think these purchases will have. And I suppose one unknown is how the GSEs will fund the purchases, which could influence the extent to which these purchases can be thought of as QE that removes duration from the market.
Yeah, Steve, you've hit on a critical shift in the technical landscape. The consolidated actions of the Fed and the Treasury are indeed creating a QE-light environment by significantly reducing the net supply of duration for private investors. Regarding the GSEs, your assumption is correct. We expect them to focus their buying on current production coupons, specifically the 4.5s through 5.5s, as they're the most effective tool to achieve the administration's goal of driving primary mortgage rates lower. While they will likely use a mix of the TBA market and specified pools, they may lean toward pools to take advantage of their attractive funding. And as for the impact, We're already seeing the market kind of, shock and awed. I am making air quotes when I say MBS current coupon spreads uh, tightened by roughly 15 to 20 basis points almost immediately after the announcement, effectively moving the index through our bull case scenario. And if implementation is efficient, we could see mortgage rates settle around 5.6 to 6% this year, which could provide a meaningful boost to housing affordability. The question of funding is where this differentiates from traditional QE. While the administration highlighted the GSE's 200 billion in cash, their actual cash buffers are near the low end of their preferred ranges. And consequently, we expect them to fund the bulk of these purchases by issuing new short-term agency debt, specifically discount notes and floaters. And I like to call that hedged bazooka, unlike the Fed, which takes duration out of the market and simply lets it sit, the GSEs historically hedge the duration and negative convexity risk of their portfolios. This means that they will likely be paying in the swap market to offset the risk of the mortgages that they buy. So because of this hedging, the net impact on aggregate interest rate levels will be much more muted than a Fed-driven QE program. However, the sheer scale of the operation, combined with a net treasury supply that we expect to be $650 billion lower this year, means that even a hedged bazooka provides a massive tailwind for the broader fixed income market. So you can think of the GSEs as sort of professional recyclers. They are clearing the bulk out of the mortgage market, but because they hedge, they're essentially processing that risk and putting refined pieces of it back onto the market shelves rather than just buying it in a vault like the Fed does.
Great points, Michael. And I think we will have a lot more to discuss on fiscal policy going forward. The administration now seems very focused on affordability issues ahead of the midterms. Attempts to lower mortgage rates and pressure credit card companies into lowering interest rates on outstanding balances, these are all part of that broader push. And I think we can expect a lot more of these sorts of efforts in the months ahead. Well, I think we're out of time. Thanks very much for joining me, Michael. And for our listeners, I'll be back with another episode of Forward Guidance immediately following the FOMC meeting on January 28th.